Hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. This is our last discussion of the fall 2021 semester, and it's on capital budgeting and investing. And it's an important discussion to have nonetheless because in business we need to look at ways to expand our business and also examine ways to at least identify how we're breaking even and what is our return on our investment, ROI. What is the internal rate of return? Uh, what is the net present value of money? Uh, these are very important things to understand and consider when we're looking to expand our business or start a business or all of those things. So, without further ado, we'll get started and finish up our last discussion for the semester. Okay. So, a couple of things I want to preface before we get started is when we're looking to expand, invest, start a business, all of these things, any of those things, we need to understand a couple of key concepts. The first and foremost being how much money do I need to set aside to get this business off the ground? What are my investments that I need to make in terms of purchasing property, plant, and equipment? And how much do I need to create to break even? How much revenue do I need to break even? And how long is it going to take me to break even? How many years? And if I invest, how long is it going to take for me to get paid back? What is the rate of return? What is the net present value? What is the internal rate of return? These are all very important concepts to understand when we're looking to start, grow, or invest. These are all very important concepts. So, looking at my business, my property, plant, and equipment, I need to understand what is my budget for that. Budgeting for property, plant, and equipment, and other long-term investments. It's really important to understand what is the budget for property, plant, and equipment. If I'm going to buy and sell property, plant, and equipment, who's involved, what is the process? For capital budgeting, which is property, plant, and equipment, we talk to the plant manager, department managers. We talk to the budgeting committee, and we, of course, run everything through the board of directors for approval, especially when it comes to capital expenses. The budgeting process is an analytical process that is difficult to some degree, and it's risky. The reason why it's risky is if you make the investment into a new building or new equipment or a piece of property, you make the investment. What if it doesn't work? So yeah, there's risk. There's risk. So it's important to include that risk in the conversation. So here are the reasons why it's risky. We don't know what's going to happen in the long term. It's always a big amount of money anytime you're purchasing property, plant, and equipment. The investment involves a long-term commitment. If I'm going to buy a building, you better believe I plan on using that building for a long time. And the decision can be difficult or impossible to reverse. You can't just be like, oh, I changed my mind after you signed all those papers to buy that building. No, you can't just change your mind. It doesn't work that way. Once there's a commitment made, you can't just reverse it. It doesn't, life doesn't work that way. When you're looking at property, plant, and equipment, and you're looking to purchase new property, plant, and equipment, you need to know or have an idea of what kind of cash flows are you going to have with that new piece of equipment? Cash flow. You all remember what cash flow is. There's cash coming into the business from sales revenue. Yeah. There's cash going out of the business, expenses. And that cash flow is very important to understand when you're purchasing a piece of equipment. The reason for that is because assets like property, plant, and equipment help the company to generate revenue by manufacturing with equipment, by storing inventory in the building, by you're sure I'm going with that. So when we look at purchasing a new piece of equipment, we look at the initial cash outflow. That's step one. How much does it cost me up front? Right? The initial cash outflow to get that new piece of equipment. The second thing I look at is how will this piece of equipment be used to generate cash coming into the business, cash inflow from revenue? Am I going to use this new screening machinery to make t-shirts? If I use it, and how many t-shirts do I need to sell for it to generate revenue? And the other thing I need to understand is when I'm done using this piece of equipment, what's the scrap value that it can get me at the end of its useful life? And to understand those things, we use a couple of different concepts, and one of them is called the payback period. The payback period is very simple. What it means is how long is it going to take me to recover my initial investment? If I buy a piece of equipment, and it, there's a cost to that equipment right up front, the cost of the investment. I need to figure out how long is it going to take me to recover that initial investment cost, the initial investment amount. And to do that, I take the cost of the investment divided by the annual net cash flow. Now, you may recall, I think it was back in Accounting 201, so Principles 1, we talked about cash flow. Net cash flow is the cash coming in minus the cash going out. Cash inflow minus cash outflow equals net cash flow. So the cost of the investment divided by cash inflow minus cash outflow equals net cash flow will give us the payback period. That's how long is it going to take for me to recover my initial investment. And of course, projects or investments with the shorter payback periods are preferred. I want to recover my investment quick, right? So how quick will tell me which piece of equipment I'm going to buy. Okay, so here's an example. Let's say that you're in the t-shirt business. You make and sell t-shirts. And to do that, you use a piece of equipment. It's called a screener. And this screener prints the logos and the whatevers onto the t-shirts. So the cost of getting a new one of those is $16,000. Its useful life is 8 years. It has a salvage value or scrap value of 0. I can produce 30,000 t-shirts using this piece of machinery. And I could sell each t-shirt for $30 per unit, per t-shirt. Let's calculate the payback period. Now remember, the payback period is the cost of the investment divided by the annual net cash flow. So in our example, our cost of the investment is $16,000 minus 0, which is salvage value, so total cost of $16,000, divided by the annual net cash flow. Well, if I expect to sell 30,000 units at $30 a piece, times 30. That's 900,000. Oh, okay. I'm sorry. Where are my other expenses? Well, I guess the other expenses were given to us. Initial cost 16,000 divided by. Oh, annual. I'm sorry, annual. I'm looking at it from. So that 900,000 would have been divided by 8 years. So 30,000 units. Okay, I got it. So 3.9 years is how long it would take for me to recover the original $16,000. Do you have a question? Okay,
No, this makes sense. This goes for
gotcha.
any business. Am I correct? Because I always wondered,
Absolutely.
how do you
Absolutely. Yeah. Yes,
go
it
about
definitely.
making your money back and actually becoming, what is the term? Well, actually, when it's just all profit. You don't, everything is paid off.
Yeah, exactly. So it'll take me 3.9 years essentially to recover that original $16,000 investment.
Do you do the same thing when it comes to investors? Say opening up a food truck. Do I add that to the equation?
No, but that will be when we talk about the internal rate of return, which we'll get to
Okay,
here in the next 20 minutes. Good question.
got it.
Yep, getting a little ahead of yourself, but yes, we will talk about that. So Lynette, if you're looking to do a food truck business, an example of this would be the cost of the food truck divided by the expected net cash flow per year. And that'll tell you how many years it'll take for you to recover the initial cost of that food truck, which is a question that your investors would ask you. It's like, okay, well, if I give you this money, how long is it going to take for you to recover that cost? And that's a question I would ask when anytime I'm investing. And we can look at that graphically. So 16,000. Because we know that the cash flows are not always going to be the same. This concept, the payback period, is with even cash flows. Even cash flows means, I plan on making the same amount of cash every year, the same amount of revenue every year. We know that's not always the case. It changes from year to year. But some businesses, it's the same amount of revenue every year. So that's what this kind of indicates, right? It's annual net cash flow. Cash coming in minus cash going out equals net cash flow. 4,100 is the rate per year. Now, what happens if it's uneven cash flow? Meaning some years are going to be better in cash, some years will be not as good in cash. So the payback period will change at that point. So what we do in that instance when we have different expected cash flows is we run it out year 0 to 8, because remember that the piece of equipment is only going to last 8 years. So if I go 0 to 8, I run out my expected cash flows per year. I'll find that my payback period is 4.2 years. How do we get 4.2? Well, at year 0, it was minus 16,000. Year 0 that's the initial investment, right? Year 1, I made 3,000 net cash. So my cumulative net cash is minus 13,000. Why minus? Because remember, year 0 is minus 16,000. I got 3,000 in, so I reduced my cumulative by 3. Year 2, I got another 4,000 in, so in year 2, my cumulative is again reduced by 4,000. Year 3, another 4,000 came in, so reduced another 4,000. Year 4, another 4,000 came in, reduced another 4,000. And then year 5, I got a bump up, 5,000 in cash came in. That put me at positive 4 for cash flow. So somewhere between years 4 and 5, I hit my payback period. So let's see how we came up with 4.2 years. 4 years plus 1,000 divided by 5,000, 1,000 divided by 5. So 1,000 divided by 5,000 additional cash flow between years 4 and 5, right? Divided by $5,000 of cash flow cumulative gave me 4.2. That's how we determine if it's unequal. So it's important to consider a couple of things when looking at the payback period. We're looking at cash flow, not necessarily net income. Okay. Cash flow, it's important to use cash flow with a payback period instead of net income, because we need to know how quickly we're recouping our investment. And you can't really figure that out from net income, because net income, we're taking out other expenses. So that's why it's important to use cash flow here. It's pretty easy to use overall. It's pretty simple to figure out how quickly you can recover your investment. The thing is, or the negative parts about this method is, it doesn't reflect differences in time of net cash flows. It also ignores cash flow after the point that the investment is fully recovered. It also ignores this thing called the time value of money, which is interest. Now, Lynette, for the investing part, this is where your investors in your food truck business are going to be interested. It's called the rate of return. The rate of return is important to know because it basically tells the investors how much they'll be getting back from their investment over time. And to calculate the rate of return, we take the after-tax net income divided by the average investment. So there's two ways to calculate this. To find the average investment, we take the beginning book value plus the ending book value divided by 2. That's for the asset, right? Beginning book value plus the ending book value divided by 2, using straight line depreciation method. Another way to find the average investment, which is more commonly used, is the sum of the individual years' average book values divided by the number of years of the planned investment. So how long you plan to keep the food truck for. So what we're doing is we're looking at the value of the food truck over the number of years divided by the number of years you plan to use the food truck for. And that will give you your average annual investment. When you compare investments with similar lives, meaning how long they plan to last for, and risk, we would prefer the investment with the higher rate of return. Higher the rate of return typically is a better investment in the long run. So looking at our t-shirt screening business, the initial cost of the t-shirt screening machine is $16,000. there's an annual tax net income, annual after-tax net income of $2,100. It's a side business, you know. So the asset 16,000 plus ending book value 0. So it's at the end of its useful life, it's not going to be worth anything. Yeah. Divided by 2. Why divided by 2? That's how you get the average. So 8,000 is going to be my annual average investment. So to find the rate of return, I take the annual after-tax net income, $2,100, divided by the average investment, 8,000. Gets me 26.25% rate of return, which, by the way, is pretty good. The higher the rate of return, the better. The only trouble with using the rate of return is that it ignores the time value of money, which is also known as interest. It focuses on income, not necessarily on cash flows. And when the income varies from year to year, the project might look really good in one year and not so great in other years. Because just because you compute
Professor, before
each year.
can I ask you a question before you go too far ahead?
Please, yeah.
Because I'm still a little I'm still a little confused.
Please go ahead.
I'm gonna use Shark Tank as an example. You
Okay.
know how someone would come in and they say, "Okay, I'll give you 300,000 for 30% of your business," but they also want to know when they are going to get their money back.
Sure.
So that formula still computes when they would actually get their money back, or I thought it was based upon each person and you give them back a little bit, you get this person back a little bit based upon the end of the year profit or the quarterly, that the profit of the period.
Yeah,
You
great
see?
question. Yeah, so it's based off of the payback period calculation that we talked about earlier, is one that would apply to that type of situation. So if you have a Shark Tank example, you got somebody who wants to invest 100,000. They're wondering, how quick am I going to get my initial principal back? You would use the payback period method to calculate that.
Okay.
Yeah, good question.
Okay.
So, which leads us into another conversation, and that's on net present value. Net present value. This concept gets a little financy. Okay. A little bit more finance than accounting, but it's still important to understand from that perspective. Net present value is when we look at the time value of money. So how much is the value of the dollar today versus the dollar tomorrow? And what's the difference? The difference is typically interest. The time value of money looks at things like future cash flow, cash inflow, cash outflow. And we look at these future cash flows to evaluate the benefits and costs of a project. There are wonderful calculators out there that will calculate net present value for you. Okay. Plenty of calculators on the internet that do this for you, net present value calculators, based off of cash flows, that will certainly help you. You don't need to use like a financial calculator physically, but you can use a virtual financial calculator to compute net present value. Very helpful, by the way. So I do recommend that you use a calculator online to calculate net present value using cash flows. It'll help you a lot. That's just a little tip. So there are two steps, or two things we look at. Two steps. We take the discount of the future net cash flows from the investment and subtract the initial amount invested from the sum of the discounted cash flows. I know it sounds complex. It is. There's this thing called the required rate of return. It's the internal required rate. It's the hurdle rate. It's the cost of capital. It's how much we're going to pay long term to the creditors and the stockholders. Internal rate of return, required rate of return. We'll talk about those things a little bit more, but not too much. This isn't a finance class. This is an accounting class, but it gives us a general sense of the value of money over time and how that value of money over time influences our investments into property, plant, and equipment, which is why we're talking about it. Net present value can be equal to cash flows. How? Well, we look at net cash flows evenly over time, and the changes in present value to the point where it equals our initial investment. So let's take a look at net present value equal to cash flows. Here's an example. We're looking to purchase a piece of screening equipment for $16,000. It'll last 8 years. Salvage value of 0. With a minimum cash inflow of $4,100 per year. Our company requires a 12% rate of return on our investment. So let's take a look. We take the inflow times a rate of 12% to get the net present value net cash flow. Inflow, rate of 12%, net cash flow. And we do that each year for 8 years. The total net cash inflows of 8 years is $32,800. The present value of the net cash flows for the 8 years is $20,367. Minus the initial investment of $16,000 gets us a net present value after 8 years of $4,367. That'll be at the end of each year. So, seeing as how the net present value is greater than the net cash flows, the investment would be worth it. Another way to determine if an investment is worth the investment or not is to look at net present value in decision making. The best ways to determine whether the investment is worth it or not is to demonstrate that the net present value is greater than 0. If it's greater than 0, then we make an investment. If the net present value is less than 0, then we definitely do not invest. How do we find this? We take the present value of net cash flows minus the amount invested, which will equal the net present value. If that net present value is greater than 0, then we make the investment. If it's less than 0, we do not invest. And this is helpful when we're looking at multiple investment opportunities at the same time. How do we understand net present value? Net present value is the value of the money today and compared to the value of money tomorrow. We can simplify this concept through present value calculations. Present value is the value of the dollar today. So if we know that, if we're going to invest $16,000 today in order to purchase a piece of equipment, at year 0, our initial investment will be $16,000. We were told that our net cash inflow will be $4,100 per year for 8 years. So we can see that at $4,100 per year times 4.9676, which is given to us on a present value index. It will give us a total net present value of $4,367 per year. Another method of looking at net present value is by looking at the cash savings from automation. Automation, especially in manufacturing, is becoming very common. Automation removes the human element to some degree and reduces labor costs. With reduced labor costs, that of course means reduced total manufacturing costs. So we can look at that as a perspective as well. We can also look at net present value with respect to uneven cash flows, because we expect our cash flow to be different from year to year. That begin through this chart. We can also look at net present value by comparing net present value projects for profitability through this thing called a profitability index. If the present value of the net cash flows is positive and is greater than the investment, we can see that we can index it. So this example, I'm looking at 3 potential investments, each having their own present value, and since each investment has a different investment amount, we can see we can index them. The index basically helps us to identify which of these 3 projects would be worth an investment. And obviously from this, we can see that investment 2 would yield the greatest results. Yeah, and if it's below 1, we typically would not invest. 0.5 is the best one. Also, when looking to invest in new property, plant, and equipment, it's also important to understand the constraints of the company and then looking at net present value projects. There are 2 forms of constraints. One is called hard rationing. It's imposed by external forces, meaning the banks are not as willing to lend. That's called hard rationing. There's also soft rationing. It's where internal management imposes the ration. IRR, the internal rate of return. The internal rate of return helps us to identify the interest rate in an investment. This is definitely used by investors. Why? Because they want to know how much percentage per year they're going to receive based off of their investment. So Lynette, when we were talking earlier, and the investors might be interested in knowing, well, how much per year am I going to be receiving back? And we know that's based off of a percentage. And that percentage is typically expressed in the form of interest. And those interests, it's like interest payments based off of their initial investment. That's called the internal rate of return. It's where we would take the present value of cash inflows minus the initial investment to get to a point where it equals 0. That would be the net present value. For an internal rate of return, and we could use this as an example, we have a project that's expected to last for 3 years. The initial cost of this project is $12,000, and our annual net cash inflows is $5,000. We're going to compute the internal rate of return. So we take the initial cost divided by the annual net cash inflows, and it will give us the present value factor, 2.4. The next thing we need to do is identify the discount rate of the internal rate of return, yielding the present value factor. So 2.4 looking at the index 2.4, we know that the internal rate of return and discount rate is going to be 12%, 2.4. This is called an index. The index shows us the range of present value factors. We said it was going to last for 3 years. So you go down the chart, 3 years, you come over, which one is closest to 2.4, and that gives you your internal rate of return, 12%. The internal rate of return can also be used and include when cash flows are unequal, because they will change from year to year. The best thing to do is to use a spreadsheet in Excel to compute the internal rate of return. The internal rate of return minus the hurdle rate. If it's greater than 0, we invest. If it's less than 0, we do not invest. Internal rate of return really is a pretty good way to determine whether an investment is worth it or not. And it also tells the investors what the percentage that they would be receiving back per year. And this is a nice summary of everything we looked at: payback period, accounting rate of return, net present value, internal rate of return. And it's really good that what managers should do is they should calculate each one to determine whether an investment is worth it or not. Break even. How long does it take to break even? Well, we can look at we could even look at that through present value concepts as well. So what we do is we create a spreadsheet. Years 0 through 8. Year 0 is the initial investment. Years 1 through 8 is when we have our cash flows. We use our present value index of 1 at 10%. We look at our present value of cash flows based off of that index. And then we run out our cumulative amount. We can see that in this example, we break even between years 5 and 6. And using Excel, Excel's your friend, especially when it comes to something like this. It's pretty straightforward because Excel has net present value and internal rate of return calculations built in. They're functions that are built into Excel, and I highly recommend that you use them when you're calculating something like net present value or internal rate of return for any type of investment into a project. And that, my friends, is the conclusion of our discussion on capital budgeting and investment analysis. Any questions, comments, concerns? Anything at all?
To pay investors back, I can do that quarterly, annually. It's up to me.
It's up
or
to
the
you. Yep,
business.
exactly. It's up to the business. In most businesses, Lynette, they usually pay their investors back on a quarterly basis. But the first thing you want to do is figure out what their annual return would be, and then just divide it by 4.
Okay.
Yeah. But that's pretty normal. It's pretty standard way of repaying investors is quarterly.
Okay.
Yeah, great question. Any other comments, questions, concerns on this chapter? Any questions at all? This is our last session together. Okay, let's talk about the final exam. Okay. Here we are in the classroom. Now, it's important to note this class officially ends on December the 5th. That is this Sunday night. This class officially ends on December the 5th. That is this Sunday night. What does that mean for you? All of your remaining work, including chapters 25 and 26, homework and quiz, in addition to Chapter 24 if you did not complete it. All of those things are due on December the 5th at 11:59 p.m. There cannot be any exceptions to that requirement. The university has a very strict policy about not accepting work past the last day of the semester. The last day of the semester is December the 5th. Okay. So with that, you must submit your homework assignment for Chapter 25, your quiz for Chapter 26, and any other late assignments that you have remaining. That must, and I repeat, must be submitted by December the 5th, this Sunday night. No exceptions to that rule. That is a university policy. I follow university policies very closely. Okay. I don't want to get in trouble. I don't want you to get in trouble either. Okay. Also, the final exam. The final exam, the current due date is December the 11th. December the 11th is the due date for the final exam. The final exam covers week 5, chapter 22, all the way to week 7, chapter 26, 22, 23, 24, 25, 26. So chapters 22 to chapters 26 are included on the final exam. A couple of good things here, okay? Final exam is a mix of true, false, multiple choice. The final exam is a total of 20 questions. True, false, multiple choice. The good news is there's no mathematical questions on the final exam. So you don't have to remember any formulas for the final exam. Well, kind of. You might need to know a few. But the good news is you can use your textbook. You can use your PowerPoints. You can review your submissions. Take a look at the exercises. These things will help you to prepare for and study for the final exam. You could review the lectures, all those good things. 20 questions, true, false, multiple choice. Covers chapters 22 to 26. Any questions on the final exam?
How many questions will it be?
20.
Thank you.
You're welcome. 20 questions, true, false, multiple choice. Covers chapters 22 to 26. It is worth 20% of your total grade. Yes, it's a lot. 20% of your total grade. Take your time. Save your work. You can save it and come back to it. Okay? It's multiple choice.
Excuse me, Professor, does it have a time limit?
Zena, no. I don't do time limits. I don't believe in those.
Okay, thank you so much.
You're welcome. That gives me anxiety. That's why I don't believe in those.
No, I just had to ask because one of my professors said one of my previous finals didn't have a time limit, and then when I took it, like it said it was time, so I just wanted to double check.
Got you. Yeah. Not for this class. I appreciate you asking. Yeah, way back when I was a student, time limits gave me a lot of anxiety. So I try not to do that to my students.
Appreciate it. Thank you so much.
You're very welcome. Lynette,
Yes.
you good?
Yes.
Okay.
I'm sorry. I hit the
No, you're
button.
fine. You're fine. It's all good. Okay. So, any other questions about the final exam? Any questions in general about the class, about the course?
Professor, what day you said the final exam due on?
December 11th.
The 3rd.
So all of your classwork, all of your homework, all of your quizzes, anything that's remaining, all of that stuff is due Sunday night, December 5th, this Sunday night. I cannot accept anything past this Sunday night. Okay. Other than that, the final exam is next week. And it's due by December 11th. Good question. Any other comments, questions, concerns? about anything at all. Anything at all about the course. It's the last thing.
I actually have a question about
Yeah.
after this class, is
Yeah.
there an accounting 3 that we take?
No.
No.
That's a good
Just
question.
wondering because I thought about when we were in accounting 1, you told us to sign up for this because they were both like
It's
in
just
this term.
I appreciate you asking that question. Yeah, it's just principles 1 and principles 2. Yeah.
Oh, okay.
Good question.
Thank you.
You're welcome. Okay, great. Okay, so if you think of anything, you need any help, you can email me, call me, set up office hours, whatever it takes. I'll be here for you, at least all the way through the end of the semester, which is next week. So all of your coursework is due on December the 5th. That's this Sunday night. I cannot and will not be able to accept anything past this Sunday night. So please make sure all of your coursework is completed and submitted by this Sunday night, December the 5th at 11:59 p.m. It will lock down at that point, so I won't be able to accept anything past December the 5th. Then you'll take your final exam next week by December 11th. The exam is open and available now, so if you want to take it early, you're more than welcome to do so. I will not penalize you for taking it early. You're more than welcome to take it early if you like. So with that, I really hope that you had a great semester. I had a wonderful semester being your professor. It's been an honor and a pleasure to work with all of you this semester. I would hope that you all stay in touch with me even after this course ends. I want you to please, yeah, stay in touch with me, definitely. You still have all my contact information. You can feel free to hook up with me on LinkedIn. I'll see you at graduation in May, at the graduation ceremony in May. I'll be there. Yeah, stay in touch. Okay, I care about all of you. Like I told you at the very beginning of this course and even last course. I look at myself as a mentor. So I want you to stay in touch with me even beyond this. It's important that I see you all succeed in life. So whatever it takes, even if you want to talk about business stuff, you want to talk about life stuff, whatever. Yeah, I'm here. So thank you all so very much for a wonderful semester together. I sincerely appreciated it. I had a great time. Hope you did too. And as always, stay safe. Wash your hands. Do the right things. All best of luck with you on the final exam and with the rest of your degree. And I'll see you at graduation. Thank you so much. Take care of you all. It's been great.
All right.
Appreciate
All right,
it.
Professor. Thank you very much.
Thank you.
Professor.
Thank you so much. It's been great. Take care. Bye-bye.
Bye.